Welcome to Money Chat. Sorry for being late, but yeah, Mercury retrograde, right? I'm blaming it on that. All right, welcome to the chill room. So I just recently moved to Tempe, and I've been coming to the chill room, and this is honestly like my favorite cocktail bar in the area. Like, shout out to Vincent and Sal and Lisa in the back for allowing me to do this event and just holding space for me. So I appreciate y'all. Thank you. And of course, Ms. Demery back there slanging drinks. Make sure you tip your bartender. All right, what are we talking about today? I've done this Money Chat event a few times, and I try to do it in a way where if you know absolutely nothing, you'll still take something from this. Like, you'll still have something of value that you can take home and you can execute like the next day. Because me, I like to talk about things, but I like to take action. If you know me personally, I'm about that action. Like, if you have an idea, I'm like, all right, how do you want to do it? Like, when do you want to start? So I'm here to lay out some strategies. I'm here to tell this, like, kind of the story of my journey and like where I'm at right now, where I came from. And then at the end, we're gonna have a little boss talk with the bossiest of the bosses, Don Sal, the father of the owner and the owner of the chill room. He's gonna share some wisdom with us as well. So I'm grateful to him for that. So welcome to Money Chat 6, wealth building strategies. Like, we're gonna talk about some playbooks today. Disclaimer, I am not a fiduciary. I am not a financial advisor. Investing comes with real risk, so make sure you do your own research. If you ask me a question, I'm not gonna tell you what to do. I'm gonna tell you what I would do and why I would do it. And then you can take that information and do what you want with it, okay? All right, so what are we talking about today? I wanted to talk about like a kind of a wide variety of things. Usually I just talk about stocks, and we're gonna like talk about stocks a lot, but I also wanted to touch on real estate. I wanted to touch on allocation. I want to touch on a new life insurance policy that I just got called the IUL. I wish my boy Darian was here. He's my agent. He's the one that kind of put me on with that policy, and I'll explain that a little bit. But I do have some clips on my Instagram of my conversation with him where we go into depth about the IUL policy, and we'll touch on it here too. Yeah, and then we're going to talk about boss talk. We're going to talk about the 2008 real estate crash. We're going to talk about how Sal had real estate during that time and how he navigated that, and what lessons can he give us for this next crash that I believe is coming here soon in the next couple of years. So I just want to ask some prompting questions as a little bit of a reframe. Like, what does wealth mean to you? Does somebody want to tell me what does wealth mean to you? Any ideas? Amy, what does wealth mean to you? Money for a future life you want to live. I like that. What about you, Sal?
Money is freedom.
Freedom.
Freedom to pursue what you want to pursue, improve your life, improve others.
Mm-hmm.
So real wealth gives you the ability to do that, not just get past the bill paying stage and really have an effect on people around you and things.
I share that definition. Freedom. Anybody else? Resources. Freedom, resources. The ability to live the life that you want to live in the future. To me, wealth is two things. Wealth is family, and wealth is time. Having as much time as you want to spend as much time with the people that you love. To me, that's real wealth. And I think that all the money and the assets and the resources, we need that stuff to really get to that thing. Like, wealth is really that feeling, like that feeling of freedom, right? All right, let's move on. Let's get into it. All right, I want to do a mindset reframe, because when I talk about stocks with people, when I talk about investing with people, they automatically start to give me reasons why they either have not invested or will not invest. And I'm gonna take those excuses off the table. Like, I'm gonna take those excuses from you so that you have no reason to not get started right now in this game. So what are the barriers to entry that I hear a lot when I'm talking to people about investing, stocks, real estate? The number one thing is money, right? I don't have enough money to get started, or how much money does it take to get started, right? So my answer to that is zero. It takes $0 to start investing, because investing is a strategy. It's a planning process backed by execution. As soon as you start planning your investment, you're investing, right? You can start with $100, you can start with $50, you can start with $1, right? One of the most important pieces of wealth building is building up cash reserves. You may spend a year just stockpiling cash. Like, do as the chipmunk does, do as the beaver does, right? Think of any creature in nature that accumulates resources getting ready for winter or getting ready for a season that we know is coming. Because we know for a fact that there's ups and downs in the market, there's ups and downs in our life, things happen to our families suddenly out of nowhere, and wealth building is the process of preparing for those downtimes so that you can enjoy it just as much as you enjoy the good times. So getting started. Also, another thing I want to say about money is if you have $100, right, sitting there, and that's all you have, and you don't think that that's enough to get started, think about it like this. Is your $100 better off sitting in cash and depreciating with the depreciation of the dollar as we know it? Or is it better off in an investment vehicle that's accruing over time, building wealth upon itself? I would rather buy two $50 shares of a dividend ETF that pays 7% monthly and let that $100 sit there and accumulate for a year, then just have that $100 sitting in my bank account devaluing with the excuse of, oh, I don't have enough money to get started. Well, guess what? The person that invested that $100, now they have like $130 at the end of the year, and you still have 100, and your 100 is worth less than it was in the beginning of the year than it is at the end of the year. So that's something to think about as well. Second barrier to entry, and to me, I think this is, of course, everybody wants to call me now. Like, I'm in money chats. Hold on one second. Yo, Eddie, I'm in money chats right now. Where you at? Yeah. I'm on the mic right now. Are you coming? Oh, man. I'm going to have to get back to you later.
Mess up, Eddie.
Yeah, I'll call you later. I thought I was going to be able to get him to show up. But. So Eddie, he's my friend. He's a personal trainer. I interviewed him in my last money chat, and he kind of gave us his story of personal training and how he built that business. So that's why I answered the phone. I wanted to see what he had to say about that. So the next barrier to entry really is sacrifice. It's sacrifice, right? Because we all make money. Like, we all have streams of income. Even the homeless man under the bridge by the highway has a stream of income, panhandling, right? Like, if he or she were to take that panhandling money and invest it, now I know there's a bunch of reasons why he or she probably won't do that, but even then, they could invest it and make a little bit more money. So we all have streams of income. Nobody's just sitting there not making money. The question is, are you willing to do what it takes? Are you willing to sacrifice a percentage? It's not even really a sacrifice, it's a gift. The question is, for every dollar that I make, what percentage am I willing to invest indefinitely, right? And that number can change. It could be 5%, it could be 10%. You make $10, you invest $1, right? That's a commitment to yourself. The same way you commit time to your employer, the same way you contribute to your retirement, the same way you pay your cell phone bill because you want to sit on Instagram and doom scroll, the same way you give money to all these other people and all these other businesses, why don't you give a percentage of that money to yourself so that in 5, 10, 15, 20 years, you have a goose egg or a nest egg that you could actually dip back into and enjoy your life and experience that freedom that we talked about before, right? So that's the sacrifice piece. And also sacrificing in other ways too, you know what I'm saying? Keeping your health in check, because if you're not healthy, it's going to be harder for you to invest, right? Keeping your social circles in check, right? Because if you're associated with people that are not serving your highest good or that are not helping you grow, then that's going to dip into your money as well. Finding the right partner. I forgot who recommended to me this book. Was it you, Sal? Did you recommend that book, The Millionaire Next Door?
Yeah, that's great.
You did? And then I think that book says that the most important decision you'll ever make is your partner, right? And all the millionaires, I'm talking about men right now, all the men millionaires, they all had a frugal wife, right? Now, I'm not saying that you have to find a frugal wife, but it just goes to show that like having a partner does have an impact on your wealth one way or another. So that's also a very important thing that you may need to sacrifice. If you're dating somebody who, you know, you're doing everything for them, you're spending money on them, you're putting time and energy into them, and they're not reciprocating that, then that might be something that you need to sacrifice to take your life to the next level as well. So, and then the third piece is uncertainty. I don't know about the market. I don't know what's going to happen. I'll tell you what's going to happen. The market's going to go down, and then it's going to go up, and then it's going to go down again, and then it's going to go up again. And that is what the market is going to continue to do. That's what real estate does, more or less. You just have to trust in that process. You know, buy low, sell high, right? Another reason why this uncertainty thing is not really too valid for me is because I've been learning that the wealthiest 1% of people in the world, they have their money in these investment markets. They have their money in the stock market, and they have their money in real estate. Do you think that the top 1% is going to allow their money to be in a vehicle that doesn't work? There's a reason why they've been wealthy for generations. I mean, there's a lot of other reasons other than that, but that's one of the main reasons. They've created these vehicles. They've created the banking institutions and the stock market and the military-industrial complex and the real estate markets. Like, they've created an infrastructure so that their money keeps on making money for future generations. And now, in today's age, it's easier than ever before to participate in that. And we don't need much, you know, a couple $1 million, that's all we need, right? A little bit, you know what I'm saying? We don't need $1 billion, but we can buy into companies that make billions and billions of dollars a year, and we can benefit off of that, right? And we'll talk about a couple of those companies at the end of these slides. I have 2 companies that I've been investing in with great success, and I'll showcase that. Does anybody here have any like reasons outside of these reasons why they would not want to invest right now?
Since the market is looking like it might take a dip, how should I increase my investment now so that it can grow eventually, or is that still the opposite direction?
No, I think that's right. I think, and we'll talk about fundamentals in a little bit, but what we want to do is we want to buy fundamentally sound companies on a discount. And the reason why they need to be fundamentally sound is because if you have a company that's not fundamentally sound and it's going down, there's a good chance it's going to keep going down, right? But if you have a fundamentally sound company that's going down, eventually it's going to go back up, because investors, when things are tough, they flee to companies that have good fundamentals, to companies that have high profit margins, that have a lot of cash in their cash reserves, because worst case scenario, a company goes bankrupt, they liquidate all their assets. At least if that happens with a fundamentally sound company, you're going to get your money back and then some. But if you gamble on a non-fundamentally sound company and they go bankrupt and they liquidate all their assets, you get nothing. So the answer to your question is yes, absolutely. But we got to make sure those companies are quality, or you're investing in quality indexes like the S&P 500, the Dow Jones, and NASDAQ, etc. Any other questions on that? Uncertainties, barriers to entry?
I think that the world is a flaming pile of like dung right now, and it's hard to sometimes think about those types of things whenever uncertainty is literally the status quo right now in every market.
I agree. There's a lot going on in the world right now. It's hard. It's very emotional right now. We just shifted into a new season for my astrologers. We're in Aries season. We're in a fire season. For my Chinese astrologers, being the years of fire horse, right? Things are burning down, and new growth is coming underneath it. But we might have to burn down some stuff in order for us to make way for the new. My answer to that is, what is the story of your wealth building journey, right? I like to think of Noah's Ark. I'm not very biblical, very religious, but I like the stories in like the Bible and other spiritual traditions because there's wealth building lessons in those stories. Even something as simple as my grandmother tending to her garden from the time I was 10 years old all the way to my age right now of 35, she's still tending to that garden, and I've watched that garden die and bear fruit and die again and bear fruit again. And watching that cycle, that's the story of her wealth building journey. You know what I'm saying? She wasn't wealthy financially, but that's the story of the abundance that she created in that garden. So I think instead of, or in addition to keeping in mind everything that's happening in the world, write your story. Write your wealth building story. How are you building your ark? Because when the flood comes, you're going to need to stay afloat somehow. Because regardless of what's going on in the world, you're still going to be impacted. Like, somebody's got to look out for you. Somebody's got to look out for your children. Somebody's got to look out for your family. Somebody's got to look out for your loved ones. I think it should be you. It should be us. So eventually we can look out for each other. Because we're all we got. We know who's with us and we know who's against us. As far as like the middle class, the lower class, the common man, like we know that each other is all we have. So we have a responsibility to be independently wealthy so that we can be there for each other when the government and the powers that be are not. So that's my story. But I'm like, what's your story? All right, let's move on. So yeah, greed is guaranteed. Oh yeah, the greed is guaranteed thing, that's what I tell myself as to why I'll never not invest in the stock market and in real estate. Because the top 1%, they will always be greedy. They will always want more. It doesn't matter. Like, we're about to have our first trillionaire. Mark Zuckerberg is about to be a trillionaire. Elon Musk is about to be a trillionaire. One person is about to have $1 trillion. And I guarantee you, he's gonna go for $250 billion. And then I don't even know what number comes after quadrillion, but he's gonna go for that too. So the greed of the capital markets and the financial markets is guaranteed, which is why I know for a fact that the markets are gonna continue to go up over time, over the long range arc of time. Hey guys, Axe Cat, what's up, Ray? Welcome, thank you for coming. We talking about money right now. We talking about stocks. All right, yeah, take a seat anyway. You can sit right here. You can sit anywhere. Grab a drink. So let's talk about some strategies. What's your stack, right? I started going to the gym recently, and there's a bunch of gym sharks. They're like, oh, what's your stack, man? You taking peptides? You taking protein? You taking creatine? What's your stack, right? So for wealth building, your stack is, what financial vehicles are you using? Are you in stocks? Are you in real estate? Are you in crypto? You have your own businesses? All of the above. You sell art, right? Art is a great investment. Especially, I know Ray, she's got some paintings that I know can go for hundreds of thousands of dollars one day for sure. So art is also a great investment. You do music, you know what I'm saying? Like what asset classes are you in, right? What's your stack? I'm gonna talk about my current stack, and I'm gonna show you my allocation and kind of how I have it divvied up. Now, these aren't fixed numbers, these allocations. I don't necessarily plan on the exact allocation strategy that I'm in. It's just a matter of what is on sale right now, right? If something's on sale, I'm gonna buy more. It's like when I used to go to the store with my grandmother, she would buy stuff just because it's on sale, even though she didn't need it. In this case, it's stocks and real estate. I always need it. So if it's on sale, I'm gonna buy it, right? So that's where the allocation comes from. So what asset classes should we invest in? I mean, ideally, all of them, if you can. I would say at least 3, like pick 3 and start there. But we have to make sure we don't over leverage ourselves. We need to have cash. We need to have a little bit of cash on the side in order to take opportunities when they present themselves, because we don't really know necessarily when opportunities are going to present themselves. We have prediction markets, right? We have financial astrology, which I'm studying, that gives us some dates that line up with volatility. We have some known dates that happen in the market, like quad witching, which happens 4 times a year, which is when money managers rebalance portfolios, and that causes volatility in the market. You can catch a discount there. We have September. September is known to be, a down month. October is known to be a down month. So there are a few known moments of volatility, but at the end of the day, you can't predict this stuff. You really can't. Liberation Day last year took us by surprise. Well, except for people that knew it was going to happen. But it took most of us by surprise, right? The markets tanked in April when it really wasn't supposed to, due to the whole tariff situation. So having cash on the side when those things happen gives you an opportunity to really take advantage of those opportunities. Hyper concentration, right? This is something that I read from Warren Buffett, and it's actually a very wise thing. It's better to hyper concentrate in fewer asset classes or fewer equities than to spread yourself too thin. You don't need 100 stocks, right? You don't need 10 ETFs, right? You don't need to invest in stocks and real estate and crypto and art and buy a kava bar and start a construction company and do this other thing over here. Just pick a few things that you're confident in, that you're knowledgeable about, that your heart is at least partially in, that you can research and grow and add value to, and invest in those and double down on those. Don't worry about other opportunities. There's about 7,000 stocks in the stock market. You don't need all of them. I have 6 or 7. That's it. With 6 or 7 stocks, I was able to make enough money to buy a duplex in downtown Phoenix, rent out one half with Airbnb, live in the other half, and I'll talk about that in a second, and then eventually rent out the other unit, and then with those 6 or 7 stocks, playing options and buying long term, I was able to buy another property in Tempe, and that's just with 6 or 7 stocks. You don't need to have 100 stocks like these money managers tell you, like these financial advisors tell you. Really, hyper concentration is the key. Warren Buffett, he did this thing. I forgot what book. I think it was The Intelligent Investor. I was reading about it in his notes. he basically challenged this money manager. He said, I bet I can outperform you by buying one ETF. And the money manager said, no way. We have all these strategies and quants and equations and things like that. We have 120 stocks in our portfolio. We can outperform you. After 2 years, he bought one ETF, which is I think it was either SPY or the VOO. It's an S&P 500 ETF, the best 500 companies in America. One ETF. He outperformed them by, it was 12%, and the money manager did like 6.5%. So doubled the performance with way less work. I guarantee you, he put money in there every few months and didn't even look at it. And the money managers were spending all day and all night trying to figure out how to outperform one stock. So hyper concentration into quality is really the key. Rolling allocations, right? Rolling allocations. So you might have, and this has happened to me, you might have a period where a certain stock is just on sale for a long time and none of your other stocks are on sale. It's okay to just invest in the stock that's on sale for a while. At one point, one stock consumed 70% of my portfolio because it was on sale for a long time. And then when it popped up, I saw a lot of capital gain from that, and I was able to roll into the other stocks that now present themselves as an opportunity. So don't get so locked into your allocation strategy, like, oh my God, I have to have 20% here, 30% there, 40% there, and then like just buy what's on sale, double down on it, and always keep some cash on the side so when the next opportunity comes, you can roll into the next asset class. So this is approximately my current stack of my wealth building journey, right? You know, most of it's in my own businesses, right? I have a tax business, Titus Tax Pros, you know, www.titustaxpros.com for all your tax pro needs. Season's still not over, and I know a lot of you file your taxes late, so make sure you holler at me. But yeah, I have that business. I have my Airbnb business. I do consultations. I do business consultations. So that's about 40% of my wealth income. Crypto, 5%, very low. And it didn't start at 5%, it started at 1%, and then it increased on its own to 5%. And that can also happen. You can put 10% into something, and it can actually increase its allocation on its own by appreciation. Real estate, you know, obviously properties, houses, you know, commercial real estate if you're into that kind of thing, and stocks, which is really how I started. You know, I started with stocks. I think stocks is the easiest way to build wealth for the average American. Like, I really do. Like, you can work a regular 9-to-5 job or even a part-time job, and you can build substantial wealth in 5 years if you're disciplined and you're dedicated and you're willing to just like cut out all the noise, cut out all the distractions, focus on your portfolio, focus on what's going on, focus on your wealth, your health, and the people that you love, the people that you care about. I really think you can. So this is just an illustration. Now, this is a very crude illustration. I use Google Drawings for this. I'm not very good at this. I'm about to have AI do these things for me in the future. But this is just to show how money flows from the outside world into your assets, right? So you have capital sales, you have tenants, you have customers, right? You're providing value to them, or you're investing into assets that are providing value back to you, and then that cash is then going into your income stream. And then your income stream is basically all the money that you're making, whether you have one or multiple income streams. And then from that income stream, you have an option, right? What do you want to do? You want to blow all your money on going to Vegas and going on vacation and doing things that you know you're not supposed to be doing right now, or do you want to invest in yourself, in your future? You want to invest in stocks, in businesses. We're going to talk about the IUL, your retirement. This is how money flows. And then obviously we have some money that has to go to the IRS. You know, they're always going to take a chunk of our money, you know, regardless of the fact. So we got to pay our taxes. We have CapEx, right? We have our capital expenditures, things that we need in order to grow our business. You know, it takes money to make money once you're making money, right? You know, these chairs and tables weren't free. You know, the lights that are on right now, that's not free. You know, these are all capital expenditures in order to make the business grow. And then the bank, yeah, for real estate, you know, you got to pay your mortgage, you got to pay you know, your escrow and all your real estate fees and things of that nature. So before we go into the real estate play, does anybody here have multiple streams of income? Josie, what's your multiple streams of income? How did you build that?
Over time, and by focusing on just a few avenues. Just a few.
Yep. concentration. What about you, David?
So what do I got? I mean, obviously work. I got a tenant, and I got some other smaller things.
Nice. So small business, your job, right? Your 9 to 5. That's a big one. And then you got some real estate, right? So you got tenant, you got rental income. What about you, Sal?
Real estate, stock, I make my hobbies work for me, do the entertainment industry, I manage property, I teach, so that kind of fuels the income investment. Mostly it's real estate and stock.
Yeah, mostly real estate and stock, man. And he said something important. He said he uses his hobbies. He capitalizes on his hobbies. That's one of the most powerful things you can do because your heart is in it. When you love something, you're gonna do it well. You're able to do it for a long period of time. You're never gonna get tired of it. So I think that's very important. All right, let's talk about the real estate play. So this is the real estate play that I did. So I've only lived in Arizona for about just over a year and a half now. And the first thing I did when I moved here was I bought a duplex, like I said, in downtown Phoenix, and it was hard. Like, this was not an easy task. Like, I moved here in the middle of the summer. I didn't know how hot it could possibly get, but I moved into this duplex, into one of the units, and I had to furnish the other unit because I was getting ready for it to, become an Airbnb and transform into that. I had to set up all the electric, I had to set up the internet, I had to deal with the neighborhood, I had to deal with neighbors. There was a lot of sweat equity that went into it as well. But eventually, I got the Airbnb running, I got it flowing, and I did a lot of education for myself. I read books on how to run a rental income, how to run a rental property, how to set up an Airbnb, how to buy real estate. The real estate game itself, that's a whole game to learn. And I did that. And then eventually, once it was flowing, I was able to, make some more money in the stock market, saved up, reinvested, and I ended up buying a property here in Tempe, 3 miles away from here, and I moved into that property, and now I'm renting out the duplex full time. The other unit has a long-term tenant in there, and the first unit still is running Airbnb. So that's the play. That was the plan from the beginning. It didn't go how I expected it to go, but the vision stayed the same, right? And I plan on doing something similar again. I've had a lot of learnings from that, and I'm going to continue to do that. Buy properties, live in it, build it up slowly over time, because real estate really is a slow game. It's a slow burn. Anybody who thinks they're going to make quick money in real estate is foolish. Like, especially if you're just an investor and you're not an agent, like flipping houses and things like that. If you're just investing, like, you have to be willing to put that money away pretty much for generations. So let's talk about the IUL. So I just got this policy. I've been studying this policy. This is a life insurance policy. It's an indexed universal life insurance policy. It's a life insurance policy where the cash that you put into it goes into a fund that buys the S&P 500. So the money that you're putting into it is appreciating with the S&P 500 with both a ceiling and a floor. The reason why they put a ceiling on it is because there's downside protection. So the downside protection basically says you can't lose, right? You cannot lose. The floor for my policy is 2%. So even if the market goes negative, which I don't think the S&P 500 will go negative, but if it did, I'm still getting 2%. The flip side of that is if the market goes really positive, like it's been going, like I know a couple years ago they did 28%, I wouldn't have gotten 28%, I would have only gotten 11% because they put a ceiling of 11%. So that's how the IUL works, right? It's an index-backed universal life insurance policy. There's other benefits to it, like there's living benefits. So it's like if you get sick or you get into a car accident or something like that and you can't afford the medical bills, you can go into your death benefit and you can take that money out and you can use it for your medical bills, right? The caveat is if you die, your beneficiaries are gonna get whatever's left. So if your death benefit is $50,000, you get hit by a car, it costs $10,000 to fix your leg, you take the $10,000 out of your death benefit and then you die, your beneficiaries only get $40,000. But I think it's worth it because at least you gave yourself a better shot at living by, tending to your medical needs. And I think that's a benefit that a lot of other life insurance policies don't give you. They don't let you actually use your death benefit. The biggest benefit to this that I love is the ability to, let's see if there's the next one, the ability to borrow against it. So once it reaches a certain threshold, you can borrow against this policy and you can take that money and you can buy real estate or you can invest in your own business or you can do You know, hopefully something smart, but essentially whatever you want with that money, right? There's probably some limitations around it in the paperwork I didn't read, but I know you can at least buy real estate, which is what I plan on doing, eventually building that policy, borrowing against it, and using that money as a capital investment. Does anybody in here have an IUL? Has anybody heard of an IUL before? You heard of it? Yeah. Rocky, calm down.
He's excited. He went
He's
out.
excited. He heard IUL. He thought I said treat or something like that. All right, let's talk stock. Let's talk about it. It's the main thing, right? So in previous money chats, I went deep into a lot of different signals that I look at when it comes to the stock market, a lot of different things that I research. I'm just gonna touch on those because I wanted to take this money chat and like cast a wider net on financial instruments. So I'm gonna talk about just like the top 5 signals that I look at when it comes to stocks. There's more, and I've been developing more. Like I said, I'm studying financial astrology, so that's another layer on top of all this that I'm implementing and incorporating. But fundamentally, these are the main things that I look at, right? Simple moving average, right? SMA. What is a simple moving average? Simple moving average basically says in the past X amount of days, what was the average price of the stock? In the past 100 days, what was the average price of this stock? In the past 200 days, what was the price of this stock? In the past 150 days, what was the price of the stock? Those are called simple moving averages, the 100-day, 200-day, and the 150-day. The one that a lot of traders use is the 200-day moving average. In the past 200 days, what was the average price of the stock? And the key there is, if it falls under the 200-day moving average, it's probably a good time to buy, especially if it's a quality company. Under the 200-day, that means that it is lower than it is at a price that is lower than a price that it was trading at for the majority of the year, meaning that this is a rare opportunity. So I have alerts on my whole portfolio for the 200-day moving averages of each stock, and when it falls below there, I get alerted. And I make a decision. Do I want to buy now, or do I want to wait for it to go down to the next, what I call retracement level, which is the next level down? So that's a good indicator. Relative strength indicator, RSI. This is a more formulaic indicator. It's from 0 to 100. All you need to know is that when it's from 0 to 40, that means that it is oversold, right? It is oversold. People are selling it a lot. Chances are the price is going down, right? Because people are selling. When it's above 40, or I should say more above 50, between 40 and 55 is kind of a battlefield. It kind of fluctuates back and forth. But once it crosses that 50 threshold, then we're talking overbought. There's a lot of hype. It's like when the GameStop era was happening, the RSI was like 8. Everybody was buying it, right? Price was going up. Probably a good time to sell if you're trading, if you have a short-term investment, or if you have a long-term investment in which you've been accumulating for a long time and you'd like to liquidate some of your profits and roll it into another asset, that would be a good opportunity to sell. I wouldn't buy there. I wouldn't buy at a high RSI if possible. So that's another indicator that I look at. Like, what is the performance of this stock? How is it trading? What's the sentiment? Are people buying it a lot? Are people selling it a lot? And that's going to give you a signal as to, to inform your decision, right? Net margins. I care about this one the most. Like this, to me, this is the most important metric. I don't care what the RSI is. I don't care what the simple moving average is. If you have a net profit margin of over 30%, you're on my watch list at least. At the very least, you're on my watch list, and you're not coming off until it goes under like 25%. That's why I like Schwab. That's why I like NVIDIA. That's why I like Meta. I like companies that have a lot of cash. I like companies that have high profit margins, because that means they're strong companies. They can invest in other companies. If we're in a worst case scenario, if they liquidated in a disaster scenario, you're getting your money back, right? That's the most important thing we think about. Like if this thing fails, will I get my money back? Well, guess what? If they have high profit margins and high cash flow, you are going to get your money back and then some. Leadership, right? Who's the leader? Like when I invest in companies, I invest in the leaders, right? Whether I know it or not. Whether I know it or not, because their decisions are going to dictate that stock price. Their decisions are going to dictate essentially my wealth, right? Same thing as if somebody's investing in you, or in your company, they're investing in you. They're investing in your character, who you are. They're doing business with you because they like you. I've had people tell me like, you know, I want you to do my taxes even though I can get it done cheaper somewhere else just because I like you, just because of you, who you are. You know, so when you invest in companies, you're really investing in the leadership, and we prefer companies that are led by their founder. Founder-led companies statistically and historically perform better in the stock market. That's why Apple did as well as it did when it had its big run. That's why Microsoft did what it did when it had its big run. That's why NVIDIA is absolutely crushing it right now. Everybody buying NVIDIA. NVIDIA is just, it's the greatest company in American history, like by far, like by a long shot. Jensen is probably one of the greatest CEOs of all time. It's just unbelievable the amount of wealth that that company has created, where low-level engineers there are millionaires. Like, that company is great. So always look at that. What's up, Axe Cat?
I just wanted to ask, like, for leadership, like, how much due diligence should be done, like, the CEO, CFO, or that, like, is that, how much of that's necessary before you invest?
It's all necessary. So when I do research on leaders, great question. And by the way, if anybody has questions, please interrupt me. Feel free to interrupt me at any time and ask me questions, because I'm just going to go off on a rant. So when we're researching leadership, what I do is, first thing I do, I go on Wikipedia. I put the person's name in, I go on Wikipedia, I read the entire article. The entire article. I want to know about their life. I want to know what they had for breakfast. Like, I'm reading about their family, I'm reading about what they did for a living. I want to know where they went to college. I want to know what they studied. I want to know what their talents are. I want to know fights that they've had with their girlfriend. I want to know everything. I'm putting my money here. This is important. Like, this is the most important thing. And I also look at the CFO as well. That's important. The CFO, if it's a tech company, which most of the big companies right now are tech companies, the CTO is very important. So yes. Yep, COO. So the whole executive suite. Yep. And then you also want to look at the board of directors as well to see if anybody on the board was a previous CEO of the company, because that's also important. We'll talk about Schwab in a minute. That's like one of my heavy hitting stocks in my portfolio right now. They just changed leadership. Like Charles Schwab himself, like he stepped down as CEO and he put in his place the president of the company at the time. But Schwab is still on the board of directors. And I have a lot of confidence in that company because of that. And the new CEO has worked under him for a long time. So having knowledge like that, which is public knowledge, is just something that you have to actually research. That's going to give you an advantage when looking at leadership. Anybody have any other questions on like some of these signals? If anything comes to mind, just interrupt me. You have a question, Brandon?
One more question is about with the acronym, with the life insurance policy that goes with the.
Oh, the IUL? Yeah, we can talk about that.
Backtrack.
No, that's okay. We can talk about the IUL. So what was your question on the IUL?
It's the who provides that, and then it's also trying to figure out, because like in the military, I had TSP plan, and that's kind of, because I'm still learning about that, so I didn't know if that's kind of the same alley or if it's different, because through that, I also can invest in like S&P 500.
Okay. All right. Here's what I'm gonna do. After this, I'm gonna put you in contact with my boy Darian. He runs America's Protection Solutions. That's where I got my IUL from. The company I use is Allianz, Allianz. That's the company that provides my IUL. But Darian is so knowledgeable about this thing. Like, and I'll send you my Instagram post that we had a 15-minute conversation about this. Like, I asked every question under the sun, and I'll put you in contact with him directly, and he'll explain everything to you. Yeah, and he can get you set up if you need that, and he'll even compare it to the one we have now and tell you if they're the same or if they're different, and if they're different, what's different about it. Right? Gotcha. What's up, Sal?
You mentioned Allianz. I think they have a different product. They have ETF, do they not? Are you familiar with it at all?
An ETF? I am not
I
familiar
don't
with
have an Allianz IUL, but I do invest in Allianz, and it's an ETF, it's a stock. And it has some of the same factors. It delivers my, it will give me a threshold underneath if the stocks go down to a certain point, but it also will hold the gain. Keeps me in the middle. And I'm just taking my stock back.
So I'm definitely going to talk to you
That
after this
keeps-
meeting about that, because that is very interesting.
Say again?
No, I haven't heard of that ETF, but I would like to know about that. So I'm
Yeah, it's
definitely
pretty
going to ask you
cool.
about that.
Well, it depends, you know, I'm a little older than you, so I need a little stability. You know, any money you invest in, if you have a bad year, keeps the floor from going out. But then again, if you have a really high, Lisa and I, I have two other investments there. They returned 16% last year.
Mm-hmm.
So my Allianz only gave me 12.
Right.
Because it.
They put the downside protection seal on
But
it.
if it went the other way, long term, it would, you know, provide.
You can't lose. Yeah.
Right,
The minimum is 2%.
When you said Allianz, I didn't know it had an IUL.
Yeah, they have an IUL. They have a bunch of other products too, financial products.
Yeah, Allianz, yeah, but you know, they're expensive along with it.
Yeah, they're good. And these life insurance companies, they have so much money. They have a ridiculous amount of money because there's so many. One, they get a lot of money for no reason for a long time. So people pay into these things for like 30 years, and they take that money and they invest it, and it compounds, and they grow it, and they have all that money. And then when people die, there's so much unclaimed life insurance policies, and they take that money, and it either goes into probate or they use it for whatever they use it for. So they have a ton of money.
Let's have another question about IULs.
Yep, for sure.
Please put me in contact with that person.
Yep, I'll put you on with Darian too.
Do you know how much you have to put into the IUL before you could borrow against it?
I think I believe, and don't quote me on this, I'll ask Darian, but I believe it's a time-based thing. So I think you have to put into it for 2 years before you can actually do that. And there's caps on the amount that you can put in. Like right now, the most I can put in per month is $300 a month. But I think I'm putting in like $110 a month for now. And then I'll increase it like as time goes on. As I offload some of the other, debts and assets and things that I have, I'll probably increase that. But yeah, they put caps because this is a government-backed insurance policy. Because it's tax-free. The gains that they make in the stock market from the cash that you put into the IUL is tax deferred. So the government puts a limit on the amount you put in, but the limit's high. It's higher than an IRA. It's like $18,000 or something like that. Like it's really high. So it's actually really beneficial. Yeah. And if anybody wants to get in contact with Darian about this, let me know after this. I'll put you guys in contact. I'm sure he would be delighted. Any other questions on that or some of these signals that we're doing?
Could you explain a little bit more about the simple moving average? That was interesting. Some 2 numbers.
Yep. So let's talk about the simple moving average. As a matter of fact, let's show you an example here. So I use a website called stockcharts.com. It's just a very simple website. You don't have to sign up or anything like that. It's just like an at-a-glance type thing. So here we go. See, let me zoom in. Make sure you guys can see that. Okay. So you see the red line that says MA 200. Are you able to see that? So that basically says in the past 200 days, if I take the opening and closing price of this particular stock every single day for the past 200 days, sum those up, and then divide that by 200, so the average across those 200 days, this is the price. So it gives you a feel of what the market thinks that stock has been worth over the past 200 days.
So you're saying 200 days is a length of time that's pretty secure, that'll show you an average that it's going to stay where it is for a while, or it shows stability?
Yeah,
what is the message of the 200 days?
The message basically says that for the majority of the year, this is what the market thinks that this stock should be trading at. So it gives you a good idea as to what the floor of that stock is. If it goes under that, that's a good opportunity to buy. A lot of traders have automatic things in their algorithm that says if it falls below the 200-day, just buy more. That's why a lot of the times you'll see certain stocks, especially volatile stocks like Tesla and things like that. If it falls below the 200-day, a couple hours later, you'll see it spike up real quick because there's a lot of algorithms that use the 200-day moving average as an automatic trigger to buy more.
Would it be out of line to ask you, what is any stock that you search for 200 days that you know it's an opportunity to buy and I'm glad you did it?
Oh, 100%. Schwab. This one.
So you look in your stock for 200 days, you see an average, and then it goes down, and then you say that would be a good time to purchase it.
Yeah, so I look at the 200-day average, so
You said you also had a trigger,
Yeah.
a notification that would alert you to the stock.
Yes, so depending upon what brokerage you use, but they all have them, they have alerts. So you can set alerts. You can basically say, when this stock reaches this price, let me know. Send me a text, send me a notification. You can also put in buy orders that say, if it hits this price, buy it. And those last for 60 days. You put the buy order out, it'll last for 60 days. If it hits that price in that 60-day window and the money's there, have to have the money there, it will buy it. I don't do that as much unless I'm really fiending for a stock. Right now, I'm not really fiending for anything, but Schwab is currently under the 200-day moving average, I believe. Yep, the 200-day moving average for Schwab is $94.85, and on Friday it traded at $94.66. So I will be buying some shares of Schwab this week. Yeah. Any more questions on SMA or anything like that? Good. And then the last one here is the WAC over the ROIC. So I call this one money in and money out. So how much does money cost this company? And how much does this company make when they invest the money that they just bought? So let me put it like this. The WAC is the weighted average cost of capital, right? So if I borrow $1,000 from the bank and they say, okay, you gotta pay me back $1,100, the WAC is 10%, right? Because it costs me $100 to borrow $1,000, right? Now, if I take that $1,000 and I invest it in Sal's business and I get $2,000 back, the ROIC is 100%. I made 100% return on that $1,000 that I put in. So it cost me 10% to borrow money, but when I invest that money that I borrowed, I make on average 100% return. So that's what the WAC over the ROIC tells you. It tells you how good is the leadership with money? How good are they with money? How good of relationships do they have with banks and financial institutions and investors to borrow money cheap? And when they do get the money, how good are they at investing it and getting a return, and a good return, right? So I look at that. That's a very good indicator. And that usually tells you about the leadership. So if you don't, I don't advise not looking into the leadership like I explained before, like definitely go on Wikipedia and look up what they have for breakfast and all that stuff. But this will tell you how good they are with money, because this is a results-based thing. This is a number-based thing. It's like, okay, yeah, you went to MIT and you studied math and, you know, you had all this success, but, you know, it costs you 50% to borrow money and you don't get a return, you know? So even though somebody could have good credentials, if that number, if that fraction, that ratio isn't good, I probably won't invest. Now, there might be some reasons for that to be bad. Maybe they just started. Maybe they IPO'd and they had to invest a ton of money for a bad price, because everybody knows when you first get a credit card, when you first take out a loan for like a mortgage or something like that, especially in this day and age, the interest rate, even if you have good credit, your interest rate's not going to be good. So take that into consideration as context. It's like, okay, maybe they just IPO'd and this is their first shot. This is the first opportunity they're getting. So maybe their WAC is high. But now I want to see, okay, your WAC was high, but is your ROIC good? Because that doesn't depend on you being new. That depends on your skills in the market and how you operate and navigate as a business. So that's something to take into consideration. Any questions on this metric? This one's a little bit more complex. No. So yeah, and for the record, there's a lot of other signals that I look at. These are just like the first like at a glance signals that I look at. I also use a website called gurufocus.com, and I'll show you this real quick. This is a paid service that I use. It's $400 for a year, but it has paid for itself for me because I use it all the time. And I'll show you like kind of how it looks. And then if you guys want to note this one, this is a good tool. So the free trial gives you a few stocks that you could look at, and then after you look at like a few stocks, they try to make you pay. So this is Guru Focus, right? I don't work for Guru Focus. I don't make money off of them. I just really love this software. Also, I'm a programmer and I can programmatically access my account. And I am building some software that integrates this with some other tools and techniques that I have, and I'm creating a new application that's gonna help me make better decisions. But this is like where I get all my stock market data from. And it does a really good job at like showing you financial strength, profitability. Over here it has the WACC over the ROIC. Now it says the WACC is really high, but banks are a little different. And we'll talk about banks in a second, but banks, their numbers look skewed because they have the ability to print money from nothing. They can create loans that are based in money that they don't actually have. So a lot of their metrics, their financial metrics, I don't even look at. I just look at their profit margin because that's all that matters to me. All right, let's move on here. All right, I appreciate y'all. Does anybody have to go to the bathroom? I know this is kind of long. Or a drink or something like that? All right. Anybody have any questions so far about this stuff? Or comments? Anything come to mind? Ray, you got something? Oh, okay. I'm sorry. Testing. Ooh, that's better? Sweet. Two left. All right, cool. All right, thank you for that. All right, so I'm going to talk about 2 stocks today, because if I talk about more than 2 stocks, I will be here all night. The first one is going to be a nuclear stock, and I did my last money chat based solely on the nuclear industry, and my hypothesis, my investment thesis behind investing in nuclear is that nuclear energy will power the AI revolution. It has to. And I demonstrated in that last money chat with actual numbers and actual data and statistics that we actually don't have enough fossil fuel energy to power the chips that are necessary for AI to function and scale and grow at the rate at which it is scaling and growing. We don't have it. It ain't there. 1 gram of uranium provides the same amount of power as 600 barrels of oil. Put that into perspective. From a storage perspective, what it takes to store that amount of energy, and from a power perspective, the amount of power that's generated. Fusion and fission as 2 paradigms in the nuclear industry. Right now we use fission. That's what the atom bomb was a fission bomb. And fission is basically splitting an atom. And when you split an atom, it creates an incredible amount of energy, right? That's one technique that we have. And we have a lot of nuclear silos and reactors around the world in different countries that use fission. And then fusion is really the next up and coming technology. So I'm telling you right now, if you hear of a stock or you find a stock that has perfected fusion nuclear energy technology, load the boat. Load the boat. Because fusion is what our sun does. The sun does fusion. And the sun has been burning at such an intensity for billions and billions of years, and it will continue to burn for billions and billions of years. So that's a testament to the amount of energy that we can create using fusion technology. So I got my eye out on that. If I see a fusion stock, I'll let you guys know.
I was just going to ask if you have a ticker.
I do. I'm about to share a ticker with you right now. Yeah, see? But before I give you the ticker, I'm just going to give you some quick stats, right? Big tech is already investing in this, right? OpenAI, Stargate, the $500 billion data center I talked about in the last money chat. They're investing in that. That data center is going to require nuclear energy to power it. Microsoft and Meta, they have direct partnerships with their own nuclear reactor companies. And I believe one of those companies are planning on building their own, probably Microsoft. Google, they're committing $75 billion to the nuclear industry in 2020. They committed in 2025. I'm sure they're going to continue to commit more to that. And yeah, nuclear power creates gigawatts over megawatts, which is times 1,000 of what fossil fuel energy creates today. So we're talking about energy on a completely different scale, right? So that's why this is so important. Governments want to dominate this space. We're having a fight over energy right now, and that's just over fossil fuels. Meanwhile, China is building nuclear reactors all over their country. We're building nuclear reactors because we know eventually we are going to need to be, and other countries are going to need to be sovereign in their energy production. You can't rely on fossil fuels. It causes too many issues. It causes too much war, and it's not scalable. They don't really care about the war part, but they care about the scalable part, right? They care about the fact that we're not going to be able to make money off of this for much longer. So the nuclear industry really is the next logical step, right? Questions on that? All right. So this is it, y'all. NLR. In October 2025, I bought 100 shares of NLR at $99. It's now at, I think, $145. Right? This stock, it's a mid-cap stock. It's not that big marked by market cap, but it encompasses the most cutting-edge nuclear supply chain companies in the world right now. So fuel processors, miners, reactors, the supply chain of the nuclear facilities themselves, companies that make the parts that are necessary for the nuclear reactors to function, the people that mine the uranium, people that fund the research behind fusion technology and fission technology, those are all encompassed in this ETF. And if you didn't know, an ETF is an exchange-traded fund. It is a stock that is linked to a pool of money that is managed by people who know what they're doing, and they are buying multiple stocks in one particular subject, in one particular target area. This happens to be a nuclear ETF, but there are communications ETFs, there are bank ETFs, there are tech ETFs, there are makeup company ETFs, there are restaurant company ETFs, there's ETFs for all types of sectors and things like that. This is the nuclear one, and this one is managed by a fund manager called Van Eck, who I'm very fond of. They perform very well. They manage another ETF called SMH, which I also recommend. That is the semiconductor ETF. Everybody calls it the AI ETF because AI is powered by semiconductors, and that has performed phenomenally in the past 2 years. So anything Van Eck does, I'm on board with, and they manage this ETF. So that's NLR, nuclear, NLR, all right? So yeah, so they're mid-cap, right? They're not that big yet, but I like it because that means the price right now is undervalued. They only have 1.7 billion in assets under management, which in terms of the stock market is nothing. That's pennies in the stock market. They only have 25 holdings, and they're actively managed, meaning they buy long term and they do options, meaning that when we have moments of volatility, you can see this perform like an individual stock, especially because it's pretty much an AI stock itself because it's being used to power the AI revolution. So this is a little dated, this metric. Given what just recently happened in the world, this is probably no longer the case. It's probably more like 65% or something like that. But as of 2025, this was up 73%. With an annualized return of 94%, so like it almost doubled from the beginning of the year to the end of the year. And yeah, there's renewed policy support all over the world for this. Like people know that nuclear is necessary for us to continue doing this AI thing that we've been doing. They're saying it's a bubble. I don't have too many opinions about that, but I just know that AI is so integrated into our lives and into our jobs and into the ecosystems that we're creating behind technology that it's not going anywhere because it is now a part of what we do every day, you know. So this is not like the .com bubble where there's a bunch of like whack websites. Like there are real companies using AI, like Nvidia, Meta, Google, Apple, like Tesla. Like there are real trillion-dollar companies that are putting everything behind this, and they're using it in ways that we can't even imagine the ways that we're using it. It's pretty incredible. So NLR. All right, and then my second favorite industry, this is actually my first favorite industry. Nuclear is more of a recent thing for me, but I've always been a bank guy. I'm money Marv. I love banks. I love money, you know what I'm saying? And banks, they have an unfair advantage in capitalist society. They have an unfair advantage. They can print money, meaning they can create money out of thin air. When they fail, they get bailed out by the government. No other industry has that. They can create loans, like I said, off of money that they don't actually have. So they can loan you $100,000 and it ain't there. It's not actually there, but you owe them that money back, and then some, even though the money that they loaned you wasn't there in the first place. That's an unfair advantage. So their profit margins is they can create profit out of nowhere, which is why I love investing in banks, because they have that unfair advantage. Is it fair? No. Is it kind to humanity and society? No. But like, we got to build our wealth somehow, you know? And honestly, we all interact with banks. They're so integrated into our lives. Like, we all have bank accounts. We all have to get paid from a bank account. It's very integrated. It's like AI. It's so embedded in society. Like, those are the companies I like to invest in. But there's one in particular that I like, which is Schwab, which I already kind of talked about, but we'll talk about it. So just a couple more things about banks. Yeah, it's very, they have a low cost of capital, like I said, because they can create money out of nowhere, especially when we're talking about the Federal Reserve Bank, which is not a part of the government. The Federal Reserve is a private bank. It's a private institution that is owned by the biggest banks in America. They're owned by Chase, they're owned by Citibank, they're owned by Bank of America. All these big banks, they all got together one day with the government and they said, hey, we're going to create this entity that acts as a central bank that allows us to print money. And we're going to make money off of every dollar that's generated in America. And that's what the Federal Reserve is. Like I said, government backed. They can't fail. The ones that are too big to fail are too big to fail, right? Like if they do fail, they get bailed out. So it's a pretty safe investment from that perspective. If you invest in a big bank, there's really no downside to it. Unless it's Wells Fargo, because they're shady and I don't trust them. So yeah, I'm not going to go over this again, but yeah, they create loans out of nowhere. They just have all these unfair advantages. Another main point about banks is they have data on everybody. They have everybody's data. They have almost as much data as like Google and Meta, like, because everybody has bank accounts. And they have financial data, which is like super powerful data to have on a large population. Do you know what kind of things you can market with financial data? When you know how people are spending their money literally from their bank account, that gives them another unfair advantage. And who knows what they're doing with that data? They're probably selling it or leasing it or collecting insights from that data and selling the insights. There's just a lot of things they can do with that. And they have high customer retention. We don't find people switching bank accounts often. You have a bank, you pretty much stay with that bank for a long time unless they screw you over or something like that. So yeah, Schwab Corporation. That's probably my top 3 stocks that I invest in. For me, it's Schwab, Nvidia, NLR, and an ETF called JEPI, JEPI, which is a dividend stock that I've spoken to you guys about, some of you guys about. It pays a monthly dividend of 7%. Annual 7% split across 12 months, but it pays monthly, and it's really affordable. It's run by JP Morgan. It's very quality. It has quality companies in there like Microsoft, Amazon, etc. So Schwab is one of those companies. I got in 2 years ago, I got in at, I think like $42, $43. It hit 100 a few weeks ago. Now we just saw it's back down to about 93. I'll probably buy more. It pays a dividend as well, Schwab, and it has great growth potential. It's got great leadership. Rocky. It's got great leadership, and he's just playing, but he's being extra. And yeah, they've been growing at an incredible pace. Nobody's been talking about this company. This company is like under the radar, which I don't know how, because they have such a large asset under management. So they have $12.2 trillion in assets under management. To put that in perspective, JP Morgan only has $4 trillion. I say only like that's not a lot, but at scale, that's an incredible amount of assets under management, 12.2 trillion. And everybody talks about Chase, everybody talks about Jamie Dimon and JP Morgan, but nobody's talking about Charles Schwab, who's been growing at an incredible pace. They have 37% profit margins, 37%. That's incredible for a multi-billion-dollar company. Like, that's an incredible profit margin. That is like buku money. Like, it's a ridiculous amount of money that they're making. And they've been growing month after month. I'll give you some monthly statistics. They also have what's called free cash flow margin. That's the FCF. So I didn't talk about this signal that much because it's a little complex, but basically it's the cash that you have after paying all your expenses. That's free cash flow. So for the chill room, after they pay all their bills and they buy all their inventory, how much money is left, right? Sounds like zero. That's the free cash flow, like, and the free cash flow margin is just that as a percentage versus like your total revenue, right? So for them it's 37%, which is also incredible. So yeah, their assets under management has grown 19% in the past year. And it's been growing at 1% every month. Now 1% of 12 trillion is a lot, right? So that's a testament to their growth. They're buying new assets. They're buying companies. They're buying real estate. They're buying technologies. Their app has been improving. They've been doing a lot of different stuff. This is a big stat right here. 395,000 new brokerage accounts opened in February, and that's up 9% versus February of last year. Now, Schwab is a brokerage. It's a bank and a brokerage, meaning if you have a Schwab account and I have a Schwab account, you can buy stocks in the stock market. So there's an account called an investor checking account. It's free. There's no monthly fees. There's no minimum balance. And they give you a checking account, which is just a regular bank account. You put your money in there, and they give you a brokerage account, which is a separate account number that you can actually put money in there, and you can buy stocks on the stock market. So that is what Schwab is. They are a brokerage. They're like Fidelity. It's like Robinhood. It's like E-Trade. And there's 395,000 new brokerage accounts opened in the month of February alone. And they make most of their money off brokerage fees, which is a small fee. It's like 2%, but 2% of 395,000 trades that are happening constantly every day, and there's millions and millions of trades that are happening every day. It's a huge amount of money, and that's only one of their income streams. Talk about multiple income streams, they have many, and this is their biggest one. And like I said, they have all the data, so they're tracking trades. So average trades hit 9.9 million trades per day. So if you make 2% per trade, and there's 9.9 million trades happening a day, and these trades are not $1, right? It's like $1,000, $500, and for bigger traders, it's more $10,000, $20,000, $30,000. 2% of that, millions per day, like it's a huge balance, right? And they have margin, right? I would never suggest anybody in here trading on margin. I won't even trade on margin. And honestly, I don't care how good I get, and people will disagree with me on this. I will never trade on margin, because if I don't feel confident enough in my investment to use my own money, I'm not doing it. Except real estate, because that's a different ballgame. There's tax benefits to real estate, right? Like, I don't mind borrowing money to buy real estate because I can depreciate the entire value of the house or the building, even though I didn't pay that entire value. Stocks doesn't give you that same benefit. So there's no reason for me to use other people's money to buy stocks, unless you are so good trading and you're so amazing and you have such a rapport and your win rate is so high and you have so much cash that you can potentially lose and still be okay. Then maybe try trading on margin, but I wouldn't do it. And margin trading is borrowing money to trade, and Schwab does that. And there's a lot of people that do that, right? In fact, $120.6 billion worth of margin is given out. And they make a lot of interest on that. And they have a lot of cash. They have $43 billion in cash, just sitting on the side. It's not operating expenses, it's not anything they have to pay back. It's just money that's waiting to deploy on assets or anything they want to invest in. They want to improve their technology. They just have all that money sitting there. They can increase their dividend. That's another thing that big companies do. They can increase their dividend to pay shareholders like me more money just for holding the stock. So that's something I like to see. And that's also increasing 1%. That's another thing you want to take note of. You want to see these numbers going up. You want to see profit margins going up, free cash flow going up. You want to see if they get new customers or new accounts open, you want to see that number going up. Netflix, you want to see subscriptions going up. You want to see these numbers all increasing. And you can find all of that out at the quarterly earnings reports, right? They have to, by law, make transparent the quarterly earnings reports that has all that data in there. And this is just a little visualization. I got this all from Guru Focus. This is just to show their chart, their stock chart, not their astrology chart. I'll get to that later. I'll get to that in a few weeks. But the stock chart, how they've been performing, obviously, in the past 3 years, they've increased, 56%. In the past year, they're up 19%. And the reason why it's only 19% is because the Iran thing, they took a hit. Everybody took a hit. But they didn't even really take that much of a hit compared to other companies. Like, other companies tanked. They took a little bit of a hit, which I'm going to capitalize on tomorrow. But, if it wasn't for that, they would be at 110 right now, right? So they've been increasing. And then this is just like how they make their money, like how they make the money on the side. They got investor services, they got advisor services. So they got a bunch of financial advisors and stuff like that, and they get financial advisor fees. They do wealth management. People that have a lot of money, they help them manage their wealth, they get paid for that. And then investor services is all the brokerage fees, the margin, all that good stuff. And then they have a small segment of assets that, pays them. Like they have real estate, and they have other companies that they own that pay them, and that they can put on the balance sheet and add to their net worth, so that if they want to actually take out a loan, they can go ahead and do that. So in summary, building wealth is time, it's freedom, it's family, right? But it's also a marathon. It's not an overnight thing. We're gonna, it's gonna take a long time. Have fun with it. Make sure you're enjoying what you're doing. If you're investing in companies, make sure you're investing in companies you're actually interested in, that you like. Try to use the companies that you invest in if possible. Like I use Schwab. I don't use nuclear energy, but I want to. You know what I'm saying? So, and then watch out for nuclear, right? Watch out for that. Watch out for fusion. Look at NLR if you're interested in investing in that space. And there's many ways to play this game. This is how I play it. I'm not saying that this is the only way to play it, or that this is even the best way to play it. I'm still learning, I'm still improving, I'm still reading books and like understanding and trying to be dynamic with the times that we're in, because one of the things that impacts the market is who's in our government and who's in our Federal Reserve and what's going on in other countries, and what the treasury notes are doing and stuff like that. So kind of understanding things from a global perspective is also going to help you in your wealth building journey as well. So next we're going to get into the interview with Sal, boss talk. It's not going to take too long, but if anybody needs to go to the bathroom or get a drink or something, go ahead and do that. Yeah, go ahead and do that. All right. And thank you guys. If you have any questions or comments, let me know. Also, you can reach me at MoneyMarFool, Titus Tax Pros. Those are my two Instagrams. I know most of you probably already have me on there, but go ahead. If you want to donate to Money Chats, there's my Venmo and I got my Zelle on there. If you want to donate, help support the cause, But outside of that, that's Money Chat 6. Next is Boss Talk.
Yeah.
Thank you.
Thank
I
you.
appreciate it. While he's in the bathroom, let's see if I can. Rocky's so happy to be here right now.
He is so happy.
Oh my God.
He just can't believe it.
I know.
That he got to come too.
I know. He's like, I got to come.
And the dog.
Yeah. Test. Check. I'll do that later. What's up?
So are you using Charles Schwab
I am.
for investing?
I am.
So
Yep.
I just
So,
got them like a couple months ago and I haven't really started anything yet with it.
yeah. So I use Schwab, and then I also use E-Trade. So I have a business called Brick by Brick Capital. It's me and 3 other partners. And one day they were like, Marvin, we want you to invest with us. And I was like, I'm not a fiduciary. I'm not a financial advisor. I can't really do that. And I was like, but what I can do is we can start an LLC partnership together, and each of you put in 15 grand. I put in 15 grand, they put in 15 grand, and we put together 50,000, and we invested it. And today we're up over 100% on portfolio after 2 years. Okay, yo, thank you.
I'm gonna be watching NLR, dude.
Yo, thank you for coming. I appreciate you. All right.
Want to do a quick Q&A, or you're?
Yeah, let's do it. Let's do it. Oh my God, Ray, thanks for coming.
Oh,
I appreciate
look
you.
forward to the next one.
Oh my God.
Sorry that
Yeah,
ran out
I'm
anyway.
gonna keep doing it for sure. Thank you. Thank y'all for coming. Bye bye. Get home safe. Let me make sure my Streamlabs, because I want to get this. Whoops. Uh oh.
No, this is my first full money job.
Nice. Yeah, it's been a minute. Hold on.
Like an opportunity, like what an opportunist.
Fast.
Right? Somebody sitting down for a free pen.
Yup.
Like you. All right, go explore. Go.
Still recording? Nice. Scooch. All right. We're gonna do this boss talk right now.
Rocky's the boss here.
All right, so we're doing boss talk here with Sal. Am I saying it right? Categine?
Yeah.
See, I know how to pronounce things. So Sal is the man, the myth, the legend. It's only appropriate that I have the first, and this is the first boss talk segment of Money Chats, and I'm having it here with the bossiest of the bosses, Don Sal Categine of the Categine family. Okay. Now Sal's gonna tell us about himself, but from what I know, he is a father, he is a husband, he's an entrepreneur, he's a real estate owner, he's a musician, he's talented, he's a Pisces moon just like me, you know, he's just a great guy. So Sal, thank you so much for doing this, thank you for holding space. He's the owner of the Chill Room, him and his family, you know, Vincent in the back, and Lisa, his wife. They run this business, this amazing business. I highly recommend the Chill Room if you're looking for some good Kava Kratom vibes. This is my favorite Kava bar. Sorry to all the other Kava bar owners that I know, but they in first place right now. I'm sorry to tell you.
Somebody got to be first.
Somebody's got to be first, right? So let's start from the beginning. So Sal, tell us a little about yourself, and also tell me how you first exposed to entrepreneurship. Let's go to the origin.
Well, you covered up, first of all, Marv is awesome. He's just great. I met him about 2-3 weeks ago. You know, when you're going around here, he spent a lot of time. He's always intense. He's always over his laptop doing something. I started him over time. So, you get to know people, you know, you get to recognize people have a pulse on things. At least I do. And after speaking with him, you know, there's a lot of layers to this man. And after talking with him, it's like, okay. So sitting with Marvin, we were just in a social situation like going to a cinema. We just did it. And we exchanged ideas, and happy to be here and happy to have you here. Thank you all for coming and supporting us. And I see y'all doing this. What's that? The market?
This one?
That's the martini.
Yeah, it's pretty in pomegranate.
Oh, the pomegranate one. Well, I did work the bar back there, but it wasn't for me when we first opened, and now that everybody's working, they're doing better without me, so that's interesting. But you said my background, real estate, wholesale. I'm a real estate broker. I got my real estate license when I was 25. Before that, I owned my own business. I was in the formal year. Had a tuxedo. I don't know if you knew that. I had a tuxedo store.
Oh, I could see you in a tuxedo.
Yeah, I was in the wedding business. I used to deliver flowers as a kid in college, and I delivered tuxedos, and then I got together with cleaning people, and the four of us invested in a nice little tuxedo store in Brooklyn. Okay, and so that's where I got a little taste of entrepreneurship. But owning a business in your 20s with 4 partners, that wasn't easy. Okay, and I said, this is just too tough. So somebody said, you make a good real estate agent. So I said, well, what about it? He said, no income cap. You can make as much money as you want. You have no boss, no employees. I said, that's for me. So at 25, I got my real estate license, and I got drove into that whole thing. And, I think the book that really turned me up, went to a lot of seminars, learned things like you all do. Find something you want to get the information. So I got my license, and I started to buy and sell residential real estate. And along the way, we did investments. We just found out about investments. So over the years, I bought and sold, flipped, bought my own properties. And was very struck by something he said, but I'll share something with you because by the time, 2008, see, with me, I had no staff. No staff at all. Everything was real estate. I worked real estate, I invested in real estate. So when 2000, I had 5 pieces of property. So in 2008, when the whole thing came crashing down, I had nowhere else to go. So imagine that. So if you lose your job and then all your investments go into fire. And I was 44 at the time, and I lost everything because everything was there. I didn't know anything about stock. I didn't invest in those. Had nothing, outside what I was doing. So my source of income to live was gone, and then all the investments, it was gone. So basically, I'm 44 years old when it's not over again. But I did learn one thing, and you do learn when you get paid. So I'm not doing that again. So to hear about that, and I didn't go to a seminar. It was just common sense. Well, I just got the crap knocked out of me. Why? Because you lost everything because you invested in one thing, and when that thing went down, everything toppled. So when we rebuilt, in fact, the good news here at LP64, in the last time since 2008, I doubled my value since everything I built from the time I was 25. Because you get older and wiser. So I invested in gold, and how's gold doing?
It took a little bit of a hit, but
Now when you buy it at 800.
right.
So somebody said, you need to buy some metals. Okay, so I bought some gold, and did well in that. So I started looking at stocks, and I took a ride in my friend's Tesla in 2013. Hey, Sal, I'll show you a car. I said, okay, electric car. I expected this little putt-putt, But I got in this Tesla, and said, this is really something. So I bought, this was in 2013, it was like, what, $95 a share. Bought some of that and watched that just, But he also said, buy something that you like, or something that you believe in. So I figured that was it. So I started accumulating stock and things that I like and started paying attention. So that portfolio has grown. So yeah, so we got some gold over there now, we got some stock doing all that, and I continue to buy real estate. Monetize, the thing is monetizing. So we have a house, and I built 2 apartments on a single family home, and that was pretty smart, because every month there's all the money that comes into on the property. That's real estate income. It's real estate income, it's gold investment, and then I got Allianz, I mentioned that, so I have X amount of money comes out of my checking account every month, whether I need it, because I understood that if I could find a way to pay the cable bill, pay your mortgage, you gotta pay yourself first. That was a piece of advice I heard in real estate at a seminar. Okay. In fact, there are people who are seminar junkies. Like Marvin did great seminars, and he talks a lot about great stuff. What I do when I go to a seminar, I write 1 or 2 points, and then everything else you kind of fade away. But find something that resonates with you. Write it down and put it to work. Don't throw it in a book. I know people do that, right? They just, so find one idea that works. I learned that how to develop my real estate business and how to become a good real estate agent. You can go to a seminar for 3 weeks, pick one thing, but put it to work. And that was one thing I heard. I said, to do that. So he's right on track. And stock is really, I got lucky in stock. I basic buy stock, but lost a clip. I'll give you a bad example of a stock. Want to hear a good one? Facebook. So I was on Facebook, and here's the new stock, right? What do I know? And there was something, I forget the name of the company. It's a local company, and it had this product that would, tackle, somebody who's doing crime. Right? They have what's the taser kind of thing? This thing is called the bolo wrap. Right? So it shoots this big net at somebody and drops them down. So I bought some stock and said, that sounds great. And it went up because in the first couple of weeks it doubled, but then it went down to, I think it started at 75, now it's worth $9. Okay, took a hit. And so I learned not what to do. So if I say, and that's what you do. You just keep trying. So you try to minimize those losses. Airbnb I thought would work out as better as it did, but it didn't work out. See, but I invest in stuff I like. I use Spotify all the time. I still invest in Spotify. That thing was triple. I don't know why. Because I figured if I like something, people like something. So, out of what I got today is,
I have a question. You mentioned that in hindsight, you wouldn't necessarily invest or invest in that product that you just described.
In what?
In the bat, the tackle.
bolo wrap.
The bolo bat, right.
Well, you know, I think it's
What-
not, I won't say invest in it, but it's not really a good idea to invest stuff that's on Facebook.
What were your
Without any
signs?
research. See, what I'm learning from Marvin is to research.
Got it.
Like, that's what it is, so that sounds like a good idea, and then what happened is it went up because the Facebook ad was going and everybody bought into it, and then when it settled out, with the true value of the company, that's what I learned later, that's where it settled. So don't buy on hype, and learn to evaluate companies. That's where in my journey, that's what I'm learning now. A lot of it, you know, it is when when the student is ready, the teacher appears, and I was ready to take it more seriously. Yeah, because we're doing well, I think, you know, we're doing well, and in the real estate business, you get money, you don't make a salary, so you make a couple good sales, also you got this money, you gotta do something with it. Sitting in the bank is not gonna be good, putting it into the modern market fund, you have to make it work. So I've also bought some art, my friend, he invests in comic books, he's an art dealer, and I know nothing, but I know my friend, and that's some money, next thing you know, it was like a 1942 Batman comic I have a piece of. Right, nice, but for 10 grand, it's just, you know, whatever, like 5 times. But then, you know, so you go with the people that you know. So what not to do, don't go on Facebook and buy the hottest stock unless.
More
you-
research is what
More
I'm
research, that's the thing. And that's why I enjoy talking to Marvin, because he says this is, like, that's why I asked the question about, the 200 thing. It's a little over my head, I'll be honest with you. That's why ETFs are good, because you don't have to do a lot of the research. That's where I'm heading towards now. Anyway, that's a little bit what's going on. You know, that's what it is.
No, thank you. Thank you. And just to reflect on that, you said a couple things that I want to highlight. The first one is related to something that I say all the time. I just said this to you last night, and Gilbert also mentioned it. You're gonna pay for your education one way or another. One way or another, you're gonna have to pay for your education. When you
We
go to
just did
school, or you go and you try and you know, to be politically correct, mess around and find out, and you lose money, like, that, there's a lesson in that. Like, there's a lesson in losses. Like, during the GameStop hype, you know, I don't like telling the story because I'm not proud of it, but it is a lesson. This is before I really started, like, researching stocks really hard. I was buying GameStop, I was buying penny stocks. I made like $2,000 on GameStop, and then the whole penny stock market was going crazy, so I put $5,000 in this one. They sold, it was called Naked. They sold like underwear, like swimsuit underwear for women, and it was like 45 cents a share. I bought 5,000 worth of, and it got up to like $2 or something like that. So I made like 30 grand. I was like, ooh, I just made 30 grand. Damn, this is easy. I took the whole 30 grand, put it in another penny stock. 2 days later, that thing was gone. I lost 30 grand in one day. And then after that, I was like, you know
Good
what?
indication.
I was like, okay, I learned 2 things. One, I can make a lot of money in the stock market. 2, I can lose a lot of money in the stock market. So I need to do my research, right? I need to invest in fundamentally sound companies, and I need to be ready for opportunities when they arise, and I need to know when to get out and stay out, right? Like when I made the 30 grand, like I should have stayed out. I should have put it in like Tempe, like Facebook or some strong company. But I decided, you know, I want to keep making more, right? I was greedy, you know, and don't be greedy and don't be impatient, you know, and don't go on hype, like don't buy on hype. Like that's a big one too. Like just because somebody tells you like, hey, you know, I heard about this new technology, I heard about this new stock, and they have this logical pattern in their head as to why you should buy it. First, I would ask them, what are the fundamentals of the company? If they can't answer it, then I won't even look at it. And also, how many shares did you buy, right? Like, if your friend's telling you to buy something, like, I would ask them, how much of your own money did you put in? Because that also holds weight. So, no, that was really good. Thank you, Sal. And I just,
Thank you all for coming.
I want to ask you one more thing.
Sure.
Because I really want to know about 2008 real estate crash. During the 2008 real estate crash, I was a senior in high school, and my family was poor, so I didn't care, because we already didn't have money. So I was just like, whatever. People are losing money, big deal. But I was also largely unaware of what was going on. I had no idea. I was in New York, just like you. I had no idea what was happening. I was getting ready to go to college. So, in your words, and I've read a lot about this, from what I heard, you know, he issued a lot of bad loans, but in your opinion, why did the 2008 real estate crash happen? And also, how did it make you feel? And how did you navigate those emotions during that time?
Well, since everything that I had was, you know, investments and my basic living income was real estate tied, it hit hard. Why? I mean, that's been put together. They've even had movies about it. But I can tell you on the ground, when you're working with buyers, and you have people who make no more than $40,000 or $50,000 a year, and they're buying $400,000, $500,000 home, there is something wrong. Banks are just overextending. You know, I mean, that's as simple as I can say. I started to see the rumblings of that. People who, you know, people had bad credit, people who didn't make enough money where they could go into a bank and get all these loans, and 125% loan to value loans. Come on, right? At the time, you know, it was just, you know, especially in Arizona, since we're Arizona, we kind of got caught up in the hype. We're very close to California, with real estate values at one point were so ridiculously out of whack. You paid $800,000 or $900,000 for a 2-bedroom, 1,000 square foot home, and you could take $800,000 at that time and buy 2 or 3,000 square foot home. So, and then all the overbuilding, all the builders came in and they saw this and they said, just get them in. You know, we have a lot of room to grow, and our position is confirmed because it'll just be worth more. There's no end to where it'll stop. Well, the second part of the question, what I did, well, the regular market was gone. I mean, there weren't anybody. People were just staying where they were, or they weren't buying properties. But you had a whole new short sale situation. Banks were, you know, a bank's goal is not to have property on the books. Okay, they don't want assets. They don't want to get rid of the assets. So it actually worked out pretty good. They would work out deals with people who were doing short term, you know, the short sales. So I became a short sales specialist. You go get accreditation and you go work with people. And it was really tough psychologically because because people, you know, in this, the idea is that people are taught to pay their bills. So you have a house that's, you know, you own the house, you're making your $1,000 a month payment, what it is. It was worth $300,000, and now it's worth half that. And people just keep paying their loans and paying their loans. They would drain their bank accounts, right? It was really a tough situation. I was part psychologist sitting down with people and with couples. It's like, yeah, that, you know, and then the economy took a hit. So it wasn't just the real estate market that took a hit as far as jobs. Everybody was losing their job. There were a lot of people. So we were all in a really tough situation. But so I became more of a short sales specialist. You know, sit down and say, okay, look, let's go to the bank. You know, the bank would forgive the difference. So I would have to sit and explain this. We were on the front lines, agents, you know, trying to explain this. No, don't drain your savings. You know, we weren't supposed to, I'll share this with you. We weren't supposed to say, stop making your payments. But that's in effect what happened. You stop making your payments and then you let the banks run the course, you know, and on an average, if it did happen today, foreclosure is about a 3-month process. You have to process it, you have to put the sale, you have to make it. So what happened was that process, because it was so overloaded, took a year and a half, 2 years. I had people who would stop making their payments and you didn't pay the mortgage, and it took 2 years for the actual process to come back. By that time, people were taking their money, and and then when they did sell the property, the bank would take less and make the forgiveness. It was a process of that. That was a 5-year period where that took. I mean, the actual depth of the market from the 2008 crash, we hit the depth in about 2012, 2013. Then it started to turn around. By 2015, 16, we were out. That was long. Because I'm in the business long enough to remember the RV, the crash of 1991. That lasted 14 months. This lasted 5 years. So, short answer is I became good at getting into the market where I was making commissions for sales, but they were, by the bank. I also became what they call a BPO technician. So I would appraise properties and, for the banks. So I did that to make money. And then that's where my property management business came in. People still rent it, so I focused on other things. You can make money no matter what the market is, like you said, any market. But that's what I did. And then once I got on solid ground, I started making money again. Then I diversified. That's made enough money and protect, in case something happened, and then, had enough money to invest in the children and work with the family, and that's what it is. So the lessons, and you said it right. So from the time I was 23 up until the time I was 44, that all, but in the last 20 years, I doubled my value. Just like, read it a little better. Now for me, I'll be 64, so my strategy is more about not growth, but making sure your maturity. And I have a plan already in the books, a 3 to 5 year plan. By the time we're 70, so this way I'm just live off of the investments. And that growth rate should grow fast, based on what I learned in the last 30 years. But you don't have to do 30 years, just listen to guys like Marv. And you can be retired, by the time you're 30 or 35, but if you do it right. I would do it a little differently, but, because I remember my first job, I was, 22 years old, had my own business. In 1980s, I was walking around with $200-300 in my pocket. In 1980, that's about what? $800? $1,000. I was going out, I was traveling, buying drinks for everybody. I had no idea, about stock, about real estate, nothing. And unfortunately, this country, we don't educate our kids. We don't, and we don't educate the finances about what to do. But that's changing. There's a moment.
That's amazing. One thing I want to highlight before we close here is Sal said, he said something a few times when it comes to adversity. He said, I became this, I became that. Sometimes in the face of adversity, you have to become something else in order to navigate the adversity. He said, okay, the market crashed. Okay, who's making money? Who can benefit from this chaos right now? The short sellers. So I'm going to go ahead and become a short seller. I just took that advice just right now, and I appreciate you because that definitely made a connection in my brain. It's like, okay, when we fall on tough times, we have to ask ourselves, what is it that we need to become to get through this and thrive through this if it happens again? So thank you for that.
I'll share something with you. There was another book I read at that point in my life. I was, how do you make you feel? It's like getting put to the starting line again. There's a book called The Second Time Around, and it's a book that focuses on success stories of people that failed miserably. Abraham Lincoln is a great example. He failed at business. He was a lousy lawyer, and until he found out what he was doing. The Kentucky Fried Chicken guy, was that Colonel Sanders? That's another one. He's made his fortune. And there's a ton of people who you can look to. So when you have adversity, look towards people who have faced the same challenges. And that's when you kind of get your gas back again. Don't feel sorry for yourself. Pick it up. And, read your books and be around a good bunch of people, that are going the same way. You're here, and Marvin's one of those guys. I'm attracted to Marvin's energy and his thoughtfulness and just, he's smart, man. I mean, he codes, dude. What the heck? The computer that I can't navigate, he builds them. It's like, whatever. So I might listen to him a little bit.
Oh my God, thank you, Sal. I love you, brother. Sal's the man. The chill room is like one of my favorite spaces. Thank you so much. I appreciate y'all for coming to Money Chats, Money Chat 6. This is the end. If anybody has any questions, reach out to me.
I have a question before you finish. So for the beginners of people going in and wanting to invest with stocks, what are your top 3 suggestions for going into stocks for people that are maybe in that same situation where you're at the beginning, you're busy, you've got a lot of stuff to do, right? And at the very end, it becomes a little overwhelming to have to do the research and know where to kind of go. So you mentioned there's a few different types of stocks. So there's the ones that'll, you can, like you were talking about Charles Schwab.
Right.
It's been going on, they have a steady growth, and it's something that seems to me it sounded safe. What are your top 3 suggestions as far as the stock industry of where to invest for people like me that really have no idea?
Yup, so right now you have to ask yourself, what sectors are being rewarded right now, right? So that is the financial sector, AI, and big tech, right? So those are the things that are being rewarded. Also, you have to ask yourself, what is the segment of the stock market that's been rewarded since the inception of the stock market? That's the S&P 500. Like I said in the beginning of this money chat, Warren Buffett competed with the money manager. He said, I can outperform you by buying one stock. And he defeated him handedly by double by buying one stock, and that was the VOO. VOO is Vanguard's S&P 500 ETF, and it pays a dividend. You can buy that one stock for the rest of your life, and you can build a fortune with that one stock. It's the S&P 500. It's the best 500 companies in America. It will always be the best 500 companies in America because as soon as one company in that S&P 500 doesn't meet criteria, money managers pull it out and they put the next one that's eligible in there behind the scenes without you even knowing about it. I'm completely fine with that strategy. That's a great strategy. That's a 12+% strategy per year. The S&P 500 did 28% a couple years ago. You know, so if you just want to buy that one stock, I'm cool with that. So that and get a dividend stock like JEPI. It has a wide array of exposure. It's got Microsoft, it's got Amazon, it's got healthcare stocks, it's got tech stocks, it's got energy stocks in there, and it pays a monthly dividend. You just keep buying that. You can buy those two stocks and you can be fine. You know, and after investing in those for a while, when your schedule becomes more flexible, then you can start looking into individual stocks and start researching and just take it one at a time. Because like I said, you don't need 100 stocks in your portfolio. You really only need like between 5 and 7.
That's a good base.
Yeah, that's a great pace.
That's a good
Yeah.
base.
Yeah, as long as your money's working for you.
So here I am coming out of the real estate thing, and I started getting back on my feet, the money was coming in, I had a big chunk of money from a good sale, and I had more stress about what to do with that money than anything. So I said, I don't need to diversify, you know, so I started a little research in gold, right, gold, silver, so I took a little bit, put it in there. And then when it came to stocks, the first thing I did was the mechanics of it, meaning like, who am I gonna talk to do I need a stockbroker? And I'm talking about, this is just me behind my computer, it's a little research. I found that and Bank of America is linked to Merrill Lynch. And I looked into it, it didn't cost any money, all you had to do is set up an account. And then you can buy and sell just with a few clicks of a button. You can set up, like my Bank of America account is attached to Merrill Lynch, so you just transfer money. Like for instance, I just put some money in there to be ready because I'm recognizing right now that since this war is going on, I'm looking at all my stocks, they're going down. So it's like, okay, no problem, I just lost 13 grand. But it creates an opportunity for all my good stocks, like Tesla was up at 4 something. Last week was 367. That might be a good opportunity for me to buy some stock when we get past, you know, because people like cattle, they run through it. So I had my Merrill Lynch account and I throw in that Tesla. So I said, okay, let me buy some Tesla. I said, what else do I want to buy? I said, you know, look at a few others that I buy. Just to, you know, try the process. Believe me, I wasn't evaluating or research. It's still too confusing to me. I mean, this is amazing. You have somebody like him. But for me, just sitting behind a computer, open the account, take some extra money. You don't need thousands of dollars. I think it only costs like $500 here, $200 there, or take extra money a month. You know, things not you don't have extra, don't go out to dinner. You know, don't take that dinner money and put it in. And like ETFs, good. I think that's QQQ. What's that? That's
So QQQ, that's another good one too. QQQ is the NASDAQ. So it's the big tech companies, Apple, Nvidia. That's the QQQ. I know people that they do a strategy called 2 Tech 2 Index. I like that. Pick 2 big tech companies and pick 2 indexes and just invest in those 4 stocks and don't look at anything else. Just do that. They'll do the VOO, which is the S&P 500, and then they'll do QQQ, which is big tech NASDAQ, and then they'll pick 2 safe big tech companies like Amazon and Microsoft, for example, or Meta and Google, for example. 2 Tech 2 Index, and you can just focus on those. But take your time. Like, I would do the indexes now, because indexes are safe, they're diversified, they're managed, to keep your money working for you while you slowly get acclimated to the process of researching individual stocks. And then once you get comfortable with an individual stock, wait for an opportunity, set a price point, set an alert. When it hits that alert, you'll be ready to deploy capital and get in. Amy?
Somebody told, start.
Yeah, start the process.
Start.
Yeah, yeah.
Even if you have $100, $200, $300, start. Overcome momentum.
I would say
You know,
also
sure, yeah.
outsource, like what you're not sure about, go to an expert, go to your taxes for a reason.
Yeah.
So find somebody you guys.
Yeah, 100%. And if anybody wants to talk to me about consultation, business consultation, talk about stocks, I can't do financial advisor technically, but I can tell you what I would do in a certain scenario, and you can take that information and do what you want with it. You know,
I already have, and he's good.
I'll say
Same, absolutely.
I've had people make some money already. What's up, Amy?
Now you guys are talking about joining the stocks on your own, and this has nothing to do with your Roths or your IRAs or anything like that. Like this is just individual stocks that you play.
Yeah,
like,
yeah,
not for the future ones, right?
yeah. So this is.
Because there's,
Go ahead.
because when you do like Roths and stuff, people do also like stock market that one.
They do. So Amy's talking about retirement accounts, right? So you have your 401k, which is a managed retirement account that has, if it's Roth, it has tax advantages, but it's also managed. So you can't pick individual stocks in the 401k plan. You can pick different segments, like sectors, like energy, tech, foreign companies, things like that. And you have a certain list of indexes that you can pick from. The thing about the 401k is that it's limited based upon the money manager of the 401k. So the money managers are incentivized to get money into their funds, right? So 401k is fine. If your job's offering it, they're matching it, do what you gotta do, that's okay. Me personally, I only allocate 1% to my 401k because I have a Roth IRA, which is, and you mentioned that's a different retirement account. It's an IRA, it's a self-managed retirement account. You can put up to, I think now it's $7,000 a year, and it's tax deferred on capital gains. So you make capital gains in there, and you don't pay taxes on it. I like that account because you can invest in any company you want. It's just like a regular brokerage account, but it has this limitation of you can only put $7,000 a year, and you can't withdraw from it until you are, I think, 59 and a half. 59 and a half. And if you do, then you have to pay a 10% penalty because there's that tax advantage. So Roth IRA, which I also have, you manage yourself. Same rules apply for me. Same rules apply. Buy low, sell high. If you do options in there, safe options. I don't even do options in my Roth IRA. Like I just buy, I do two index in my Roth IRA. I got VOO, Nvidia, Jeffy, and Amazon. That's it. And I just buy those Roth IRA. I let those sit. And then for brokerage account, I have, NLR, Jeppy, Nvidia, Google, Schwab, and I think I got one other company in there. But I apply the same rules to every single stock investment, whether it's a retirement account or individual stocks.
That's so good, you guys, so good.
Thank you. Any other questions or comments? Got any parting shots, Sal?
It's on the right track.
Thank you guys. I
Great
appreciate
job.
you.
Thank
Thank
you.
you, Sal. Thank you to the children.
Thank you, Rocky.
Thank you, Rocky, for entertaining us. Y'all have a great one.
And now I gotta go to work, see?
Just like that, one-stop shop.